Welcome to the economy. The equity markets cheer over the twin good news of S&P upgrade and promise of GST cuts looks like lasted only for a day. The bond yields have done worse. Yields fell on Thursday after the rating upgrade. They fell to as low as 6.42% from 6.5%. But currently, today, they stand at 6.51%, a 10 basis point increase almost. This is the highest level since April 9, which means not only the rating upgrade, but even the 50 basis point repo cut of June is being ignored by the bond markets. Clearly, the market is worried that the centre and definitely the states may borrow more this year than budgeted, which means at the moment, the bond markets don't think the economy will grow fast enough to give more tax revenues to the government. To get a 360-degree perspective of the economy, the fiscal deficit, inflation, interest rates, I have with me two preeminent economists, Soumyo Ghosh, Chief Economic Advisor of State Bank and Finance Commission member, and Samiran Chakraborty, Chief Economist, Citi, India. Gentlemen, thank you very much indeed for your time. And a bigger thank you to you, Soumyo Ghosh. Soumyo has just come out of the, yesterday evening from the government meeting with economists and landed at 3 a.m. in the morning in Mumbai. So deeply grateful to you, Soumyo. Well, for starters, what is the sense you are getting? Is the bond markets worry that the fisc is going to be stretched, that there may be even extra borrowing from the states and centre? Legitimate fear?
Yeah, thank you, Latha, and thank you for the nice introduction. If you just give me 2 minutes, I'll just explain. I think, yes, there are two sides to the story. The first is the potential revenue loss is going to happen because of this GST rationalization. I think there is various estimates in the market, but we think that the revenue loss actually is it's two sides of a coin. On the one side, you will lose the revenue. On the other side, you will gain the revenue because you are moving 28% to 40% some of the goods. So from there will be an equal share distribution with the center and the states. So in the end, the revenue loss could be anywhere between 1 trillion or so for a whole year. So that means for the next 6 months, it could be around 50,000 crore. So obviously the fears of the bond market is that whether this 50,000 crores will be, or this 1 lakh crore or whatever is the amount will be able to be adjusted by the center in its fiscal numbers. Our sense, we believe that I think there is a deeper aspect of the story. As you know that the compensation cess has ended, but the center has given back-to-back loans to the states, with the states now repaying. And this year already around 6,000 crore has been repaid. Around 49,000 crores will be repaid in November 2025. And next year, April, I think the entire amount of 130 trillion will go out. So the entire repayment will be made. So and there is also an amount which is lying in the compensation cess.
Okay.
The estimate could be closer to this 50,000 crore number. Okay. So our sense is that in the overall analysis, the revenue loss could be compensated significantly by this compensation cess, because the states will now be free, because this money will not be deducted from the states, because they will not be repaid to repay the amount. So
Got it. So your math is suggesting is that the bond markets is probably worrying in vain. That, for this year itself, it's only going to be probably 50,000 crore shared by centre and states. Part of them could be met for the centre at least from the excess money lying in the compensation cess. Samiran, this math, I'm not hearing it first from Soumyo. Something akin to it is available in the market. It is floating, though not so precisely. Then why is the market behaving the way it is behaving? What is its worry?
So thanks, Latha. I think I almost entirely agree with Soumyo on this. To start with, the way I put it is that tax is a zero-sum game. So if whatever amount the consumers are going to gain, it is going to be exactly the same amount, which will be a revenue loss for the government. But for us analysts to estimate that amount, which will be the gain for the consumer or for the loss for the government, is very difficult because of at least 3 reasons. One reason is that we do not know how much is going to be the pass-through of these tax cuts to actual prices. GST is an ad valorem tax, so we might not see the entire reduction in revenue because the companies might not pass on the entire price cut. The second is obviously the Latha argument that actually economic activity, consumption might improve because of tax cuts, and that will lead to higher revenues. So there are multiple such things which are very difficult to estimate at this point of time, including something like input tax credit. So whatever number we are working with right now, there is a considerable band of uncertainty around it. I think the market is reacting to that uncertainty.
Okay.
That confidence that was there in the market, that fiscal deficit will definitely be met at 4.4%. In fact, could be slightly better because of higher RBI dividend and a higher nominal GDP number. That optimism might have got a hit, and that's probably the reaction that we are seeing.
Okay. Soumyo, since you are freshly landed from the capital, one of the guesses of the market could be that there is a fiscal package coming for exporters. Surprisingly, today, all the textile stocks are doing well, actually, or many of them are doing well. Is there a chance that something will be designed for those who are impacted? You see, the data is there with the government. Who exported what to the US last year? And therefore, to compensate them for the extra penal 25% is not methodologically difficult. Will that be a course the government may take?
No, I think there, as I have understood in the media, I think there are something which is being worked out in terms of a compensation structure for the exporters. So what form it will take, it is a little difficult and tough to say at this point of time, because again, it is uncertain. We don't know when the trade deal is going to materialize, whether this 50% will stay from the end of August till this September when the Prime Minister visits the US. So basically the trade deal could culminate at the end of September when the Prime Minister visits the US. That also is an uncertainty. So my sense is that, yes, there is some package which the government is thinking about, but the government is also in a wait and watch mode to see what will be the impact, because already reports suggest that August exports have been significantly front-loaded. So maybe if we can pass through this period of August, there will be another month of uncertainty. So maybe all these options the government will look into, but there is obviously an option of looking into a package for the exporters, specifically the textile, gems and jewelry, made-in products and others, which is a significant share of exports to the US market.
Oh, yes, marine, very big. I mean, the shrimp exporters are practically entirely dependent on the US. And for what it is worth, the state of Andhra is a political ally of the centre. I mean, they may help even otherwise, but that's also a point. Samiran, I went through your note. You are saying that there is a 0.6 to 0.7 benefit or percentage of GDP benefit because of all the cuts, the income tax cut, the GST cut, etc. Will all this be taken away if it is 50%? And are we working with a flat GDP? You have not given the negative, obviously, because there is uncertainty. But what is your ballpark guess?
So we were partly anticipating this stimulus of about 0.7 to 0.8% of GDP, including the income tax cut, the GST cut, as well as the interest rate cut. On top of it, there could be some additional coming out of higher credit growth if it materializes. So ballpark, let's say about 1% of GDP is the stimulus towards the households. Now, one question is how much of this stimulus is going to be spent versus saved. And that is more a function of consumer sentiment, which in turn could be impacted by the wealth effect coming out of asset prices. As of now, the asset prices have been pretty flattish, which is why probably the consumer sentiment is somewhat weak. And that's why we are not yet seeing the larger part of the stimulus being spent rather than saved. But on top of it, we have this headwind of how much fraction of the GDP I should take out because of the higher than expected tariffs. Yeah. At this moment, it's so fluid that we haven't been very precise in that estimate. We have put it in the form of sensitivity that at 25% tariff, it's still about 0.3 to 0.6% of GDP is a sensitivity. However, our estimate has on growth for FY26 has always been a notch higher than the official estimates from RBI, because we thought that because of some statistical reasons in the first half, as well as the stimulus impacting in the second half, we should see a slightly higher growth this year than what the current estimates are. So we are slightly ahead of the street on this.
Okay. You know, another factor which we are not discussing, but the stock market is giving us some signs. L&T did not rise. Yesterday, there was a 1%, at one point, even 1.5% gain in the markets. It was all consumption stocks. Capex was clearly sulking. Soumyo, should we worry that, the Capex expenditure might soften, and definitely in the states, if not in the center, because they are likely to be hit more by the GST?
Yeah, I think, Latha, that's a possibility because capital expenditure at 3.1% of GDP at 11 trillion in the budget, I think has already reached its peak. But you also need to understand that there is an grants which the center gives to the states as a part of the overall larger fiscal architecture, which is around, I think, which adds to around 1.2% of GDP. So my sense is that as long as these grants continue, this creation of capital assets will continue in the states. And the states have also been given this 50-year interest-free loan, capital expenditure by the center, which has been used quite well by the center. Of course, there are conditionalities. So my sense is there will be some impact on the capital expenditure. Obviously, it has peaked and it cannot go any further higher from over there. But again, I think it's a matter of debate how much the hit will be because the evidence on this is still forthcoming.
Okay. All right. Okay, I'm being hounded that I'm running out of time. So 2 quick questions. Same question to both of you. Samiran, does the CPI fall even further because the GST will bring down prices of some things? What are your rate cut forecasts now? 1 more cut, 2 more cuts?
Latha, it's difficult to give you a precise number on CPI because we do not know what the pass-through for the companies are going to be. But 11 to 12% of the CPI basket is likely to be impacted positively by the GST cut, with medicines and apparel being the largest components within that is what our sense is. Not putting in another fresh rate cut right now because it seems like the RBI is looking at the forward-looking inflation number, which still remains quite elevated.
Okay. Soumyo, bringing down inflation, are you? Rate cut expectation?
I think if we assume that there is a full pass-through, the impact on CPI could be as much as 45 basis points, 40 to 45. But even if there is a 50% pass-through, I think their impact would be around 25 basis points or so. So I think there will be obviously an impact on the headline inflation. But the important thing is that at this point of time, again, we are not building it any rate cut by the RBI, and we believe that the RBI will wait and watch the next year's CPI new base, these new numbers. So see through to see what will be the impact on the headlines. Yeah.
Okay, that may be the other reason why the bond market is not reacting. Okay, I want to invite both of you again to look at the new Gen Next reforms that the government is contemplating. But since it is just on the cards, we will postpone that for the next time we meet. Thank you very much, Samiran and Soumyo, for improving our understanding of the macros. We wrap up on Bazaar Chartbusters coming up.